Stoked to be here. Thank you for having me, everybody. I'd like to say thank you to the HTDC for prioritizing education here. I think it's something really important in the cryptocurrency space, and we're really happy to be a part of the DCIL and be able to offer Bitcoin services here. So a little bit about me. I've been an entrepreneur here on Maui since 2013, and my company Cloud Nalu has been focused on helping small businesses grow with integrating with technology. So as a tech integration specialist here with many businesses and the Department of Education for a while, working with schools, I really found a passion in onboarding businesses or existing business practices to better technology tools. And it's a fun space to work in. But for the last year, I've been working with integrating businesses with blockchain technology and specifically Bitcoin. Previously, I was a developer working a lot with Ethereum, creating smart contracts, creating NFTs on IPFS, writing code with Solidity, and really working with that blockchain. But for the last year or so, I've been focused solely on Bitcoin and the Lightning Network development. It's really an exciting space to be in right now because of all the layers that are being built on top of Bitcoin and all the features that Bitcoin can provide. So today, Cloud Nalu is a software development and integration group focused on Bitcoin products and specifically Bitcoin development. So we have a website platform where you can easily register and link your local bank account and buy Bitcoin and store Bitcoin securely. We prioritize our clients to help them not just buy Bitcoin, but store it securely in a multi-signature wallet to educate their family about it or to onboard their business to it by setting up a point of sale system where they can accept Bitcoin. We see ourselves as the boots on the ground here in Hawaii for integrating businesses and family offices with Bitcoin who want to use it as both a store of value, but also a way to just make payments easier and more seamless, and final settlement happen more quickly and instantaneously on the Bitcoin Lightning Network as a business. So we do a weekly webinar on Tuesdays called Bitcoin Tuesdays, and then we do some of these fun, super awesome HTDC webinar events. And our past ones were, let's see, what did we do? We did intro to wallets. We talked about investing. We did a Bitcoin 101. And this one today is going to be on really all the other cryptocurrencies out there. There is an estimated 9,000 of them. So it's a pretty crazy space to be in. A lot of small technological developments and always a new token or new cryptocurrency coming out. But I think today we'll also talk about how Bitcoin has solidified itself as really the money of cryptocurrency. But there are some very cool use cases for other cryptocurrencies and other technologies, which we'll get into.
Sure. So Liam, do you actually want to run the poll? I know you asked to run the poll. You want to do it now? Or
yeah, I think now's the perfect time.
Okay, let me just launch it. So if you're watching this webinar, it's going to be a poll coming up. We appreciate if you put your responses in. Okay. I think you can see it too, right, Liam?
Yeah, cool. I'll vote myself. Oh, hosts and panelists can't vote.
I think our audience is doing really well. Let's see.
Do we have how many people are in attendance today?
Yeah, we have 28 so far.
Oh, that's awesome.
And let's see, 67 participated. There's a couple of more people putting their responses in.
Wow. We did a little radio interview show with Bert from his, what's that show called?
Bite marks.
Yeah, Bite Marks, thanks.
Okay, I'm going to end the poll now. So we have 21 out of 28 people with responses. Let me see if I can share the results. Everyone can see it, right? Liam can see it as well.
Yeah, cool. So pretty much everybody got it right. Link is actually a token based on Ethereum and the ERC20 protocol. So we have cryptocurrencies and we have tokens, which I will get into the differences between those. And then Bitcoin, nobody guessed Bitcoin, but Bitcoin's definitely a cryptocurrency. Many people are viewing and using it as money. Even recently, El Salvador has declared it legal tender, so you can pay your taxes in Bitcoin over there now, and that sort of thing.
Interesting.
So I will get into the presentation then.
All right, go for it.
We're going to kind of wing this today, and I'll see if I can come up with some more fun polls along the way. Maybe Ellen, you can help me out with, or just some questions to pose to the audience, and maybe we can generate some more questions. But business is business. This is not financial advice. I'm not a financial advisor. This should not be construed as investment advice. I can't really recommend one cryptocurrency over any other, or recommend you buy cryptocurrency as opposed to any other asset. So please don't take this as financial advice. We're going to talk about, first of all, doing your own research and how to do that when analyzing various cryptocurrencies and tokens. We'll talk about token economics, which is kind of like looking at the supply and demand characteristics of each cryptocurrency or token and the market activity behind them, how the cryptocurrency or token was structured to be released to the public, whether it was mined or if it's even really mined at all, and then the incentives built around the cryptocurrency or token. Third, we'll go over the protocols. So there's really just two different protocols in this space right now, but there's some enterprise protocols also being developed as well. So these are like the rules of each cryptocurrency and the rules of the blockchain and how those work, and the benefits and drawbacks of each of those. And then we'll talk about kind of just wing it and see if anybody has some cryptocurrencies they'd like to look at. Ellen, would that be okay if we just had people maybe type in the comments a cryptocurrency that they want me to talk about?
Yeah, sure. They can leave it in chat. It's hard for me to set up the poll in the middle of a webinar, but they can definitely leave their responses in chat.
Okay, cool. Let's do that. And okay, I can see the chat. Cool. And yeah, and then we'll compare them to Bitcoin. So how to do your own research. This is a very important part of this space. You can't really get honest opinions or much honest research from a lot of the space. Honestly, you really have to dig in to find the facts and truth about a lot of these cryptocurrencies. Oftentimes you'll have to even dig into the code and to verify things. But there are companies out there that have made it their business to really dive in and research cryptocurrencies and share with you the facts and stuff like that. So we'll look at where to find and how to do your own research and where to find resources. So understanding cryptocurrencies can really help you make better investment decisions with your money. It's the stocks are pretty easy to vet, right? Like you can look at a stock and you can see its market research. There's a ton of information out there about them. They are SEC regulated, so they can't like lie about issuance with a stock. But with cryptocurrencies, it can be different. And you really have to rely on the code and trust the code and trust the cryptography behind the cryptocurrency. So ways to start at least your cryptocurrency research. For most people, it's YouTube. It's checking out YouTube. It's learning from a YouTuber that's into cryptocurrencies. The problem with this is that they'll often spend a lot of time on what's called technical analysis, where they look at the chart of the price action, and they'll talk a lot about that. But it's really hard to find on YouTube fundamental analysis, meaning more about why this cryptocurrency exists and the problems that it attempts to solve, and where the market is going for tools that can potentially solve those problems. So the next place would be to look at the market activity. So is this cryptocurrency even active? Is it trading? Is it at its peak? You definitely don't want to buy a cryptocurrency when it goes parabolic. So we've all seen those charts where you see the curve and then it like blasts off, and your friends are all talking about it, and everybody's talking about it on the news. That is generally not the time to buy a cryptocurrency or a token. You really want, if you're using it as an investment tool, you want to wait for when it really bottoms out and creates some sort of structure in the chart. So structure in the chart can generally refer to positive structure would be a nice big W. So you can look for a kind of a W shape where you get two bottoms and then a breakout. You want to be wary of cryptocurrency charts that have an M shape to them, where you have a double top and then a breakout of the bottom. Kind of wish I had a diagram for that now, but you can look at market structure on CoinGecko and Cointelegraph, and those are good places to check out market activity. And one really cool feature about CoinGecko is that they kind of help you analyze what's called fake market activity. So we have blockchain activity, which is on-chain data, which is really easy to measure because blockchains are often very transparent. For example, the Bitcoin blockchain, you can know exactly when people are sending their Bitcoins to exchanges. Oftentimes that means that people are looking to sell Bitcoin when they go to exchanges from their wallets. And then you can look at when Bitcoin are coming off of exchanges. And that generally means that people are looking to hold their Bitcoin in a secure storage solution, such as a multi-signature wallet. And they're not looking to sell for a long time or a reasonable amount of time. I'd encourage you to check out my presentation on wallets and the importance of offloading your Bitcoin from an exchange. So you can see a lot of that market activity, those on-chain metrics on CoinGecko or Cointelegraph. But with CoinGecko especially, you can see the fake market activity. So market activity generated by exchanges themselves, just to kind of sometimes boost a token's hype or excitement around it. If a token has a lot of volume or buying and selling going on with it, it's going to generate a lot of hype and excitement because people think that the next move for that cryptocurrency or token might be for it to go parabolic. People are always trying to, or traders are always trying to get in at the bottom before something goes parabolic and sell at the top. You can also see institutional activity generally, and when the big players are buying a specific cryptocurrency. So big players often use their money very wisely. They buy in at the bottom of a range. They buy in when they see a cryptocurrency such as Bitcoin make a big W, and they see nice volume coming in, and they look for divergence, and they enter their trades then and buy a lot then. So millions of dollars worth of Bitcoin. And you can generally measure that and see that on-chain data. So really fun to check out. I'd encourage you to circle back to those websites, CoinGecko and Cointelegraph. They'll tell you how to do technical analysis. But also, again, YouTube is great for technical analysis. From fundamental analysis and more research behind like what makes a cryptocurrency useful or interesting, that would be sites such as Messari. So these are research dedicated websites that read a lot of white papers and really look for news about various cryptocurrencies, and take a look at the founders and the development teams behind them. They'll look at the market activity and do a lot of analysis for the cryptocurrency. And Messari is awesome. They're free. That's what I like to use if I'm ever interested in other cryptocurrencies. And then we'll check out the white papers. This is kind of the deep dive into researching any particular digital asset, is checking out the white paper. The white paper is generally the info about and the design decisions about the particular cryptocurrency or blockchain. And they'll go over the tokenomics, why they chose what they did, what new technology it presents and what it attempts to solve, and how rewards are given, how the cryptocurrency is mined, stuff like that. You can also check out a cryptocurrency's website. That's a good place as well. It's a good place to find the developers or the CEOs or the founders behind them, and you can pull up their LinkedIn profile and kind of check out their background. And you should also know that on these websites, they can tend to be kind of vague, which is why you end up often going back to Messari, where you get more of a deep dive into more of an unbiased look into the cryptocurrencies, because websites will often talk a lot about the philosophy of banking the unbanked and stuff like that, and throw in a bunch of buzzwords about their cryptocurrency, rather than really explaining it in really unbiased technical form. You definitely want to vet your resources. We've talked about that, but key is to recognize hype and overhype and recognize scams. In 2017, I think a lot of us in Bitcoin land have kind of PTSD from that, because everybody wanted to be Bitcoin. There's a new cryptocurrency token based on Bitcoin every single day. And it was just insane. And it ended up being quite sad, because a lot of people put a lot of their money into all these other cryptocurrencies that were trying to be Bitcoin, but they didn't have the open network effects that Bitcoin has, the distribution, or just simply the scarce store of value qualities that Bitcoin has. A lot of those cryptocurrencies are inactive anymore. So I think we're kind of past that. I think most people recognize that Bitcoin is really, as I said, the money of all cryptocurrencies, and everything else is generally just a new way of trying to do something with the blockchain or with a smart contract. In decentralized finance, meaning allow people to put up their tokens and get yield by using cryptocurrency to offer lending services, basically. So I'll give a quick definition of DeFi, because I think that's going to come up a lot in this conversation. DeFi, or decentralized finance, is really a way to, or an idea to use your cryptocurrency to offer loans and lending to other people in a decentralized way. So you don't necessarily know who you're lending your cryptocurrency to. And you often do this on a decentralized exchange or a DEX. Common DEX would be like Uniswap or SushiSwap, Cream, various other DEX. I did a lot with DeFi last summer and played a lot with creating smart contracts and decentralized finance. But I think personally, on a personal note, I think a lot of that space is overhyped and quite risky to be in, to put your money locked up in. This past week, actually, there was the largest cryptocurrency hack, smart contract hack in history on the Polychain protocol, and $600 million worth of cryptocurrency, various tokens, were hacked or stolen. So we'll get into that and the risks of putting your money in a smart contract. But it's important to recognize the drawbacks of, or the real case with a lot of these cryptocurrencies, that there are scams out there. And if your hard-earned money is something that you can't risk not losing, you definitely don't want to put it in a smart contract. I generally just stay away from Ethereum if you can. And most people would say make sure to invest in something with a real store of value that will protect your wealth and secure your wealth in the proper ways, such as offloading your Bitcoin to a multi-signature wallet. So here's a fun little shot I love to remind people of. Is there's a lot of hype on YouTube, so stay away from these guys. They're just trying to emotionally get you to subscribe to their channel and offer some pretty vague technical analysis, and really isn't the best way to do your own research. So next, we'll look at the tokenomics. So this is really taking a look at the supply and demand characteristics of an asset. Tokenomics is the study of how cryptocurrencies work with the broader ecosystem. It covers all the aspects of a coin's creation, distribution, management, incentives, design, and sometimes removal from a network. So when you have a token, you want to let people know why this token is being issued, and give people an incentive for rewarding or collecting a reward in the token, and then giving them an incentive for maybe keeping the token. Things to look at when you're looking at tokenomics would be questions such as, well, we'll get to the next slide. Looking into the design, the distribution, and the roadmap. When we talk about design, we're really talking about what the token is designed to do or reward. So what is it designed to reward? And often you have a smart contract based on a cryptocurrency such as Ethereum. I guess I should quickly define smart contract. So a smart contract smart contracts have been around forever, since I'd say maybe the 80s. But it's really a way to code what a contract should do. It's inputs and its outputs. And when you write a smart contract using Ethereum, you're coding the smart contract often in a expressive language such as JavaScript, and you can code the inputs and the outputs, what that smart contract should do. So if you wanted to lend cryptocurrency to somebody, you would have them put up some collateral in the smart contract. You would make sure the smart contract rewards you with interest. And then if the person defaulted on paying you interest, you would have the smart contract maybe take their tokens or take their cryptocurrency. You might have that smart contract reward you or 100 million users of that smart contract with a token. These decentralized exchanges, these DEXs, are basically giant smart contracts with millions of users. I'm not sure how many users are on Uniswap these days, but it's a lot. A lot of people are using Uniswap to trade Ethereum-based tokens across the network. And Uniswap, through their smart contract, decided to reward their users some time ago, I think last summer, last fall, with what's called an airdrop. So they airdropped free Uni tokens, and they created a new Uni token for their smart contract DEX. And all the users that had been using the DEX were rewarded with this Uni token. And people gave value to that token, Uni. And then people were able to buy and sell that token. So smart contracts are quite interesting technology, as they can kind of create value in a way. But it's important when looking at a smart contract and the token issued from a smart contract to ask yourself, is this designed to just like be some hype right now and generate a bunch of income for the developers, or is this designed to be a store of value for the long run? So if it's not a store of value in the long run, and you're just getting some interest on that smart contract, you want to be careful about it. Also, with smart contract design and tokens issued from smart contracts, is they can be hacked, as we saw just this last week with that $600 million Polychain hack. It's not like Ethereum is getting hacked, right? Ethereum is based on cryptography and it's proven pretty much unhackable, but these smart contracts can very easily be hacked. And we'll talk more about that. But next up, we have distribution. So how are a product's tokens distributed? You want to look at how many tokens were created in the future, or in the beginning of the project, how much was maybe pre-mined by the developers before the project or the smart contract was released to the public. And you want to take that into consideration, because if a token or a cryptocurrency had a lot of like distribution beforehand to the people within the project with a direct link to the project, such as the developers and stuff, they could dump all those coins on the market later. And if you are holding coins or tokens, you could easily lose value if that happens. So one really cool thing about token economics is you can generally look and research at different cryptocurrencies or tokens and see how much is held by the first people to own the cryptocurrency, and how much is held by newcomers, and how often those newcomers are trading cryptocurrency or the token. And that is a good way to look at, to answer that question, are these coins going to be distributed and potentially worth more in the future? Or are the developers just going to come back and dump a bunch of coins on the market and make these coins valueless quite quickly? You can also look at how many coins or tokens currently exist. So on the Bitcoin blockchain, that's really easy to do, which is the awesome thing about Bitcoin is its transparency of the blockchain. It's really easy to validate how much Bitcoin is in circulation, how much Bitcoin has been mined, and how much we have left to go. So today we have 89% of Bitcoin has already been mined. And you can see on the blockchain that only about 7%, I think right now, of all Bitcoin produced in existence is liquid or available to be sold on exchanges. So if you think about the consequence of tokenomics like that, where you have a very small amount of the total supply of coins available to be bought and sold on exchanges. And what happens if, let's say, $100 million comes into Bitcoin from some, institutional investor, and they want to buy Bitcoin? That's definitely not going to tank the cryptocurrency's value. That's going to skyrocket the cryptocurrency's value. So if you think Bitcoin is expensive now, I'd encourage you to just look at the token economics of it and the supply and demand of it, and where it could potentially go. I think about 100 million people around the world use Bitcoin today. And if you look at the population of the world, there's 8 billion or almost 8 billion people out there. So there's a lot more people in the world and a tiny bit of Bitcoin left, and an even tinier amount of Bitcoin available to be bought and sold on exchanges. These are one of the things that makes Bitcoin such a great store of value. So that's an example of tokenomics research. Next up, we have a roadmap. So how is the token managed throughout the project's timeline? So as I was kind of alluding to earlier, is you can have the developers issue themselves the token beforehand. And you want to stay away from projects that the developers issue themselves the token a lot beforehand. If the token is issued in increments down the road, they'll often explain and discuss that in the white paper or on the project's website. You can read about that on Sorry. And you can even kind of schedule your trading activity or your investment ideas based around the timeline of the cryptocurrency. Ethereum is on a really interesting timeline right now, as they're moving from their proof of work protocol, or the proof of work protocol, Bitcoin's protocol, to a new protocol called proof of stake. And we'll talk more about that later. But the key is that the timeline of this is in stages, and you can read about and look at the stages of that roadmap on Ethereum. It's really interesting. I don't think anybody's really ever tried to convert a cryptocurrency in this way before, and it's a very complicated, kind of nervous process, because a lot could go wrong, but potentially some people at least think that proof of stake might make more sense for Ethereum, especially if Bitcoin has proven itself as the money of cryptocurrency. Maybe Ethereum on proof of stake could be something else, something other than money, maybe more technologically interesting in another way. So finally, with that roadmap is you can look at, is there any events on that roadmap where cryptocurrency coins or the tokens will be burnt or deleted or made somehow unusable, because that would in effect, again, affect that supply and demand issue. You have less supply and the same amount of demand, then generally that token should be worth more on the market. All right, so I know that was a lot. I wonder if there's any questions in the chat so far. It doesn't look like it. Cool, so we'll move on. So I kind of mentioned we have different protocols, and protocols are the rules and guidelines that are used for cryptocurrency and to achieve consensus of the blockchain. So consensus of a blockchain is really how that blockchain validates each new block that's added or appended to the blockchain. And there's basically two ways of doing this right now. And the first one is proof of work. So proof of work is really a consensus mechanism, and it's what Bitcoin is built on. It's the protocol that Bitcoin is built on. And it's where miners have to be trying to solve for a hash of a block that will be added to the blockchain. And it requires a lot of energy, this proof of work, because it's really like finding a needle in a haystack. These miners or specialized computers called ASICs are just pumping out hashes as fast as they can. And if they get lucky, they'll get the hash that allows them to add the next block to the blockchain. And they'll be rewarded with Bitcoin for doing so. And it's really what this algorithm is really what makes Bitcoin so secure, because once this algorithm is solved and the block is valid, then the hash of that block is able to point back to the entire history of valid blocks before it. Meaning that if you wanted to change one transaction in a block or a few blocks back, you would have to have the hash power to rewrite the current block, and then the hash power of the block before it, and the hash power before that, and all the way back to whatever transaction you wanted to change, making it pretty much impossible and ridiculously expensive to do so. You really have to use up all the energy in the world somehow to rewrite the Bitcoin blockchain. So that's what makes the Bitcoin blockchain so secure, is really this proof of work protocol to achieve consensus on the blockchain, to achieve truth on the blockchain. And one really cool thing about proof of work and Bitcoin's blockchain is that each block is only 1 megabyte in size, meaning that the entire blockchain right now is only about between 350 and 400 gigabytes of data. So anyone in the world can pretty much download 400 gigabytes of data, right? Like it takes a pretty small hard drive, maybe like less than $50, definitely less than $100 worth of computer equipment to download the entire Bitcoin blockchain, and then therefore be able to run your own node and validate your own transactions and validate the entire Bitcoin blockchain yourself. It's really what's made Bitcoin so distributed. And that distribution has gave it a lot of benefit because it is really secure and uncensorable because of that distribution. In order to censor Bitcoin, you can think of it as like a game of whack-a-mole, where you can try to knock down one node, but there's millions of other nodes out there running this blockchain. And so that proof of work protocol is really what gives Bitcoin its security. And proof of stake, that POS on the chart there, is what Ethereum is trying to move towards. So Ethereum was initially built on proof of work, but they're trying to move towards this proof of stake protocol. And there is a lot of other cryptocurrencies out there that are already built on proof of stake. But this proof of stake really removes the need for work. And theoretically, it's less energy intensive or not energy intensive at all, because it doesn't require energy, it just requires staking. So how that works is a validator or somebody who wants to be a staker on the network might put their tokens up, might lock their tokens in the blockchain and make them unusable, and therefore stake them on the blockchain. And in doing so, they're able to validate all the other transactions happening on the blockchain. And they're rewarded for doing that. So right now with Ethereum, if you have 32 ETH, you can be a staker on the network, a validator of the blockchain, of the Ethereum blockchain. But you'll have to lock up your Ethereum, meaning you won't be able to sell them or move your tokens, your ETH, to somebody else for 2 years. So I think right now, this move towards proof of stake, Ethereum's in stage 2. Now, both proof of work and proof of stake reward valid blocks, but there's clearly a difference in how they do that. With Bitcoin, you're rewarded a valid block if you provide hash power to the network and you're mining for that ability to add the next block to the blockchain. But with proof of stake, you're really buying your way into becoming a validator. You're putting up, you're maybe buying, or maybe you've mined tokens in the past, and you're then putting up those tokens on the network to gain yield, gain a reward from from staking your token. And there's definitely interesting drawbacks you can see to that. So we said, what are the benefits of being a staker or stakeholder? Yeah, that's a really good question. So being a stakeholder, you kind of are a person who's allowed to earn a reward on the Ethereum network. So if you have 32 ETH, you can put your ETH up and you can stake your ETH and lock them up and then get a reward in Ether or in more Ether on the network or on the blockchain. And the thing about this is you're then an individual, and it's kind of like you bought your voting rights, and then everybody else has to kind of respect your voting rights and hope that you're truthful in your actions on the blockchain, hope that you're creating valid blocks and you're not putting in a transaction that's disingenuous. And you're rewarded for being disingenuous, for being truthful on this proof of stake protocol. So there's definitely drawbacks to that, because you can see how that could potentially centralize the Ethereum blockchain. It certainly centralized some other blockchains that are based on proof of stake as well, because you have generally kind of a small group of people that are providing all the validation on the network. Whereas in Bitcoin land, you have hundreds and thousands of nodes on the network, all validating transactions and making sure that the transactions or the blocks that are being added to the blockchain by miners are distributed throughout the network. And that way nobody can put invalid transactions on the blockchain. So you could argue that both these protocols offer a way to decentralize, to provide decentralized nature to their blockchains. I think you can kind of get the hint at where I stand on this issue, and why I think proof of work in the end presents such a better form of decentralization. And finally, I'll talk about enterprise blockchains. So this is like Hyperledger you might have heard of. I think Polychain is technically an enterprise blockchain. There are blockchains that theoretically banks could use, or other enterprises, supply chain companies that require a lot of validation of a database. So these are often private blockchains, where just the enterprise keeps their blockchain, and they maybe only share it with their counterparties, people that they do business with. So if you were a shipping industry person, and you had tons of products and shipping containers coming on and off your ships, it would probably be quite smart to look into an enterprise blockchain that was maybe built on proof of stake. That way you could save a lot of energy costs and upkeep, and also know that your products and shipping containers all over the place were where you think they are, or that where your database says they are. So there could be some good use cases for that. You probably wouldn't want to put your entire shipping container or product database directly on the Bitcoin blockchain, because that would require a lot of energy, right? But there are some cases and developing cases where you might want to add that to layer 2 or secondary layers on top of the Bitcoin blockchain, where you're using proof of work as that base layer, that really solid proof of work, secure blockchain. But then you have these other layers on top of it that allow you to transact instantaneously and for zero cost, and not use all the energy of the base layer. So there's a new consensus mechanism, or a new layer being built on top of Bitcoin, called discrete log contracts. So it's a kind of funny word, pretty bad word for how awesome it is. But discrete log contracts, or DLCs, are basically smart contracts on Bitcoin. And you could potentially attach a oracle or outside real world data to the Bitcoin blockchain through a discrete log contract. If you're interested in this, check out some of the things that SharedBits is a company. They're working hard on this. But the use for discrete log contracts could be really interesting, because you could use the base layer blockchain of Bitcoin and then put all this other real world data on top in another layer above the base layer of Bitcoin through these DLCs. And real world data outside might include the weather, who won a certain game or not, who won the vote in an election, stuff like that. And if you have a discrete log contract on that, you can again change the output of that input, and have that output potentially reward or send Bitcoin to somebody else, or something else could happen. So again, a really interesting second or third layer being built on Bitcoin, where you use Bitcoin as the base layer of final settlement, but these other layers on top of it. All right, so that's kind of an overview of the different protocols. How are we doing on questions?
There are 2 questions in the Q&A, Liam. So not sure if you can see it.
I think I got the stakeholder. I think I went over that.
Yeah, and in the Q&A, not the chat. So in the Q&A from Matt, he's asking,
right.
Yeah, what are the top 5 currencies and top 5 tokens?
Yeah, we'll definitely get to that. All right, so I think that might even be the next slide.
Time check, Liam. We have 5 more minutes.
Oh, wow. Okay, cool. So cryptocurrencies, the native asset of the blockchain, can be like ETH or Bitcoin, whereas tokens are created to serve a purpose or reward of an existing blockchain or smart contract. So again, you can have tokens being rewarded from the smart contract. So yeah, let's look at some various cryptocurrencies. The top 5. So I can tell you right now, the top 5 are Bitcoin by far, the number 1. Then Ethereum is pretty much always number 2. And let's look up. Let's use Coin Telegraph to look at what the next 5 are. So I am sharing my screen here, and I'm going to. We're gonna just go to cointelegraph.com, and we can see the top 5 are Bitcoin, ETH, XRP, Bitcoin Cash, EOS, and Doge. Another place to check that would be CoinGecko, because honestly, I want to check the validity of that, because I don't think that's right at all. Okay, so I think that was the volume. So previously I just talked about the top 5 volume. So the top 10 cryptocurrencies right now by market cap are Bitcoin, Ethereum, Tether, which is a stable coin based on US dollar, Binance Coin, which is a way to trade cryptocurrencies on Binance, Cardano, which is a cryptocurrency that now has recently allowed you to build smart contracts on it, and XRP, which is kind of a pretty centralized cryptocurrency, but marketed as a way to allow banks to more easily transact with each other, as opposed to using the SWIFT network. Then we have Dogecoin. Wow, I can't believe that's still in number 7. So Dogecoin is an interesting cryptocurrency. It's based on Litecoin, which is based on Bitcoin. So when I say based, it's a fork. It's a fork of the code of Bitcoin and then the code of Litecoin. And with Dogecoin, there's no cap on the number of Dogecoins that can be mined. So they can continue to be mined, and supply can continue to rise, which is kind of one of those tokenomics factors that you want to be wary of, because if there's an infinite supply, that means that there can just be infinite produced, and your coins might never become actually valuable. But there's a lot of hype and marketing activity around various coins. For example, Polkadot has a great marketing strategy, and that hype can generate into real value. We have some other requests for, let's say, Chainlink. That's one of my fun ones. So let's go to Masari and check out Chainlink, because that is an interesting one. So Chainlink is basically, I mentioned oracles. So Chainlink takes real world data and allows nodes to validate it. And then other blockchains and other cryptocurrencies can use this oracle and to do their own smart contracts. So they use the token Link, which is based on, it's a ERC20 token based on Ethereum. to validate this Oracle data. So if you look at the 24-hour, we can look at the year to date for Chainlink. This is kind of a nice market structure here. We have a bottom, and then we're going up. So you could almost say that this is forming a W. I wouldn't say this is a real solid technical analysis W, but another good thing to look at is here, you have clearly an M here. So you have a top there, and then the second top there, and then it breaks out of the low part of the M down there. This is a lot easier to do on a site like TradingView to look at the technical analysis, but you can see generally what can happen after an M forms in the market structure. Uniswap we kind of talked about, so I switched that. Let's see. So where to get some of these cryptocurrencies? Yeah, BlockFi, Gemini. Those are places you can get them as a Hawaii resident. And you just want to be careful about not only the fees that you're paying for trading those cryptocurrencies, but also the spread of the buy and sell on those exchanges. So you want a tight spread, meaning a tight, yep.
Sorry, Liam, I think we had another question and then we have to kind of wrap up. So Kaimina is asking in the Q&A, what are your thoughts on Tether and Ripple?
Yeah, great. So Tether is something that it was really the first stable coin to be issued. So Tether said that, you know, we have these assets of US dollars, and we're going to create this cryptocurrency called Tether, and it's going to be backed by our US dollar assets. The problem with this in the long run is that they weren't really regulated, and nobody really could validate that the Tether's backings of US dollars actually existed. And over time, Tether has actually let us know that it's actually not backed by US dollar assets. It's backed by other assets. So you want to be careful about stable coins that aren't actually backed by real assets, such as the US dollar. I would argue a better stable coin to use would be USDC. That is a much more regulated stable coin and therefore better. But it's important to understand that holding stable coins don't generate you value. You can offer them in a smart contract to generate yield by lending stable coins to other people, but you wouldn't want to just hold on to a stable coin like Tether or USDC. Stable coins are tokens, yes, often based on the ERC20 protocol, based on Ethereum. So they're nothing that new or technologically interesting, but they do provide a lot of help for people in the market that want to trade Bitcoin or other cryptocurrencies easily by cashing out to a US dollar-based stable coin. It's also a lot easier for people to price assets like these cryptocurrencies in stable coins rather than price them in Bitcoin. We can look at Tether on Masari, and you can come to the profile and you can see a lot of the history of Tether. This is a great way to look at the stablecoin's history and where it's listed and all the ongoing controversy behind Tether and its recent audit. And then I'll just do one more question for my last slide.
Yeah, so I think, Liam, there's one last question from Yas. Yeah, sorry, I don't know if I pronounced your name correctly. I think the person's asking about AMP Flexa.
Cool. I don't honestly know a ton about AMP, but the Flexa is the side chain for AMP, I believe. AMP is a token issued for yield, basically. So it's kind of like a DeFi token.
And then for DeFi, he's asking for Uniswap and Shiba token.
Yeah, Shiba token is kind of a play on Doge. It's kind of a joke. token, but more embraced by the Asia Pacific countries and people there. Yeah, and then Uniswap is the token issued from Uni. It allows you to generate some more yield on the Uniswap DEX exchange. One thing I just want to get clear is Bitcoin versus everything else. There are so many more benefits of Bitcoin compared to all the other cryptocurrencies. It provides, as I've noted, really solid verification. It isn't dependent on centralized parties or a centralized group of developers. The economics behind it really play into the supply and demand token economics. It is provably scarce. There's only ever going to be 21 million Bitcoin. That gives it perfect scarcity and a great store of value. And the risks behind Bitcoin, since your tokens aren't locked up in a smart contract, nobody can hack your Bitcoins from you. Really, the only risk of holding Bitcoin is potentially losing access to your private key, which for most people, you'd have to be pretty dumb to lose access to your private key. No offense to anybody that's lost their private key, but it's pretty easy to just back up your seed phrase or even hire us to help you create a multi-signature wallet so that if you lose one of those private keys, you can easily use the other two keys in a 2 or 3 multi-signature wallet to regain access to your Bitcoin easily.
Okay, great. So I think, Liam, we have to wrap up because we are past 10.
All right.
Why don't
Wow,
you, but I'm sure people would have questions for you.
Yeah.
Do you want to leave your contact email in the chat box so that people can reach out to you directly, if that's okay?
Yeah, for sure. So I'm at liam@cloudnalu.com, but a really great way to ask us questions is to sign up for a free discovery call. And we will walk you through all your questions about Bitcoin and our services and help you formulate a plan for investing in Bitcoin or even investing in cryptocurrencies if you really want to get into the rest of the stuff. My email is in the chat now. And I would also encourage you all to check out our website, cloudnalu.com/events, because we have these Bitcoin Tuesday events where I just kind of walk you through our platform and answer anybody's questions live on YouTube. And we go through a lot of these awesome aspects about Bitcoin that make it so secure, verifiable, and such a great asset to hold.